So one alternative asset in particular I want to talk about is life settlements because that's a key area that I have been involved in the last 12 years or so, and it's an area I'm trying to educate RIAs about as well. So investing in life settlements allows investors the ability to seek assets that are discounted at high rates and potentially achieve net returns anywhere between 7% to 15%. Again, with liquidity depending on the structure involved. So it really affords RIAs and their clients the ability to access otherwise institutional type investments, alternative assets, and provide portfolio diversification where their bond portfolios used to fulfill. Again, investing in life settlements usually requires specialized actuarial and insurance expertise. So that's the method in which they're able to provide additional risk-adjusted returns and value to their clients. And through the use of an institutional asset class, and as we'll see in the following slides, many institutional investors have invested in the space. So now let's kind of talk about the nitty-gritty, right? What is a life settlement? I've never heard about it before. Well, this is your opportunity to learn what it is and why it's an attractive asset class for a lot of institutional investors. So a life settlement is a financial transaction in which the owner of a life insurance policy sells his or her beneficiary interest in a policy to a third party for a value greater than he or she could receive from merely canceling it. So what does that mean? So a policy owner decides that they no longer need or want or can afford the policy. So they realize that a lot of policies, actually never pay a death benefit. A lot of these policies, and as an actuary has priced these life insurance policies, a lot of these are designed such that the policy owner never actually gets a death benefit, but will pay a lot of premiums in the policy and then cancel it, right? The policy owner realizes that if they cancel it, they'll get hit with surrender charges and not really receive a lot back. So they realize they actually get a lot higher payment from selling the policy on the life settlement market than they can from just canceling it. The other issue is that they can't afford or don't want to pay the expensive premiums on the policy. It just doesn't make sense anymore for them. So let's again look at the transaction process. The policy owner decides that he or she can no longer afford or no longer needs the policy, right? Perhaps the policy owner bought it when they were much younger and they had children who were young, and now they're older and their kids have grown up. They don't really need the life insurance, but they want a cash payment and want to do anything, essentially liquidate that investment and use the funds for other purposes. So essentially what they're doing is that they're selling the policy to an investor who wants to buy the policy from them in exchange for a cash payment. The life settlement buyer then takes ownership of the policy. The policy owner takes the cash and walks away, but the life settlement buyer, it has to pay the premiums to the life insurance company. So the great thing for the policy owner is they're no longer responsible for paying the premiums and they get the cash payment and get to walk away. The life settlement buyer, on the other hand, they are in fact paying the premiums, but they will get the death benefit proceeds when the policy owner or the insured on the policy dies. So you might be thinking, well, I understand why a policy owner would sell their policy. It makes sense, right? Since they can liquidate at a higher amount than they could from canceling it. But why would the investor want to purchase it? Well, oftentimes the insured is in a lot worse health now than when the policy was purchased. Especially if they were in great health, they got a policy with low premiums, but now they had some health mishaps or they've gotten older and they're in worse health. So essentially there's an opportunity, there's a mortality play here where the premiums are low relative to the underlying risk. The other reason that investors would want to purchase this life insurance policy is that they have access to actuaries or actuarial software to determine the minimum premiums to pay. Oftentimes, a policy owner of a life insurance policy is paying way more into the policy than needs to be. And the reason they're overpaying is because they don't have the expertise to kind of figure out, well, how much do I really have to pay? Can I pay less than what the insurance company wants me to? So they don't have the expertise, whereas investors, the investment community does. Again, they're treating this like an asset class because it does have asset class properties. The other thing is that the investors realize that if they select the right policies, they can provide high, stable returns, right? So they need a diversified pool. They can't just buy one policy. They have to buy a diversified pool. But essentially, it's using mortality risk. It's understanding insurance risk and how to manage that and be able to use that expertise to buy attractive policies and achieve attractive uncorrelated returns, right? Because when people die is independent of whether the market goes up or down in a given year, right? So this is a great way to use specialized skill, which is actuarial expertise and insurance expertise to provide uncorrelated returns. So the next thing people often ask, well, who has invested in this space? Well, as we talked about, it's mainly been an institutional type asset class. So you've seen AIG, Berkshire Hathaway, Fortress, Apollo, all, collectively they've invested billions of dollars into the space. So, and the reason is because it makes mathematical sense, right? If you can get a diversified pool of policies and have the right actuarial and insurance expertise, it's a great way to achieve higher risk-adjusted returns. And that is exactly why these kind of institutional investors have invested in the space. So why should RIAs kind of be looking at this asset class in this environment, right? So what we've done here is shown kind of, the discount rates applied to life settlement cash flows versus the discount rates kind of applied to bond coupon payments. So here in blue, you have the discount rates on life settlements, and you can see it's been between 15 to 18% over the last 5 years or so, whereas bond yields have been significantly lower. So we're going to look at two types of bond yields. We're going to look at the high yield corporate debt versus the high quality. So they're kind of opposing, right? The high yield corporate debt has less quality. There's more risk involved, right? And that's why you're getting the higher yield. Whereas the high quality here in red, it's again high quality corporate debt, so backed by companies that are doing well, have a great balance sheet. So there's less risk. So obviously less risk means less yield. Again, the high yield corporate debt has more risk. So we can see the spread here between the high yield and the high quality. But the opportunity here is that the discount rates applied to life settlement cash flows are significantly higher. So there's an opportunity here for groups with the right expertise to manage this risk and essentially get a risk premium, achieve a higher risk-adjusted return relative to investors that are just investing in high yield or high corporate debt. Again, the risk premium here is that you need to have the right expertise, right, in order to realize this opportunity here. But that's essentially why institutional groups are investing in this space, because they realize even if they don't, there's an opportunity. There's such a huge spread, right? In a volatile equity and low yield environment, life settlements offer significantly higher return profile that, as we mentioned, is uncorrelated to economic conditions, right? The underlying cash flows are mortality-based and insurance-based, not dependent on market conditions. And it's essentially an institutional asset class, right, that is made available now to retail investors, family offices, RIAs, and even, again, other investors, through life settlement funds. Again, I've written a white paper on this topic. So if you wanted to learn more about the space, if you're an RIA or family office looking to provide better diversification than bonds, higher risk-adjusted returns, you can find this paper here on life settlements on the Colva Services webpage, or you're just clicking on the link.